Hey, Ashley. All right, we still have people loading in right now, but I want to respect everybody's time and get started. My name's Adam Stevens. I'm CEO here at Reach Home Loans. I've got my business partner and co-host Brandon. He's going to be going over some of the strategies that we've been deploying over the last month, and we're launching a new buy down strategy. But in general, I just kind of wanted to go over with you guys kind of what's going on out there and the choices that you have in the market today. And what I'm seeing out there, I'm seeing three different things. I'm seeing people panicking, right, which is pretty easy to do. If you're looking at the headlines, all the numbers are terrible, and that strategy is really not going to get you anywhere, right? That's definitely not the strategy that we're taking on. Two is to keep doing the same thing that you've been doing over the last 2.5, 3 years, right? So that may or may not get you through, but we know things have changed dramatically in the last really 6 months. So when things change in the market, buyers' sentiment changes, these are things that you have to adapt to. You have to make sure that you're differentiating yourself from the competition out there. The third thing you can do is really play into the new market and use it as a competitive advantage. That being, there's always new things that are coming out, new products, new programs, even if it's not a product on your side of the fence being real estate, a product on the mortgage side being buy downs, right? So using those different strategies as a competitive advantage, but that's really all about being able to communicate what you can do differently than your competition, right? And I know that you guys have heard a ton about buy downs. I'm sure you've gotten texts, you've gotten emails. Any lender under the sun is, talking to you about buy downs. But what does that really mean? How does it work? And what does that mean to you? How can you use it to your advantage and really set yourself up for success? And most people just don't understand how to communicate the buy downs and what that means for a listing agent, buyer's agent, the actual buyer, how much money it can save them, and putting that strategy in place. And it may be a 2 or a 3-step process to show that buyer value, right? And that's what Brandon's going to be going over today. And more importantly, we kind of had this whole slide deck set out, right? It looked really nice and it showed you a couple of examples. We scrapped all that and we said, let's just go back to the whiteboard and go over real world examples from the perspective of a listing agent, from the perspective of a buyer's agent, stuff that you guys are really seeing in the streets every day. So you can, take a real live example and see how you can use these strategies and, more importantly, communicate those strategies to your buyers, and how you can sell these things. As a listing agent, how can you get more listings? As a buyer's agent, how can you come up with rebuttals when somebody says, you know what, I was thinking about buying, but I'm going to have to wait for interest rates to come down. Well, what are you going to say to that? Most real estate agents really don't have anything to say to that. So we're going to be going over those things with you today and show you exactly how to present these options to your buyers. We're also going to be introducing an additional buy down. It's a lender buy down. It's a proprietary product that we put together with one of our investors. So if you're not actually able to get a seller buy down, you can still provide a buy down for your buyer without any type of seller concession. So if you take away anything from this, or maybe during the process, what I would say you need to do is focus on how to communicate what Brandon's going to be going over with you, right? How can you communicate this to the other agent, to the buyer? Because although it may be second nature to us, and over time it should be second nature to you once you understand really how things work, it can be very overwhelming for a buyer. They don't understand. They don't do this every day. They don't necessarily understand how these things work. So we've got a Q&A box down below. You guys should be able to see that. So at any given time, if you guys just want to type in a question, I'll let Brandon kind of run with things, and then we'll do our best to answer as many questions as we can when he gets wrapped up. So I'm going to go ahead and turn it over to Brandon, and enjoy.
Hey everyone, Brandon Brotsky. I'm the president here at Reach Home Loans, also the division origination director here for the company. Now, something that makes me different than most presidents of mortgage companies is I'm very heavily involved in the origination itself. I still originate loans. So I'm seeing what's happening out there on the streets, what's working for some agents and not working for others, and what's really being used to get deals done that maybe wouldn't have been deals if we didn't utilize these strategies, as Adam had mentioned. So the biggest thing that Adam said is that you're hearing about buy downs, and Adam mentioned you're probably getting texts, emails, you might have done other webinars talking about these buy downs. And something that's important to know about most of the buy down products that are out there right now is that they're seller paid, which means that the only way a buyer can utilize those buy down products, whether it be a 3-2-1, a 2-1, or a 1-0 buy down, is that the seller has to agree to give a credit that's large enough to cover the entire cost of the buy down. It's very, very important. A lot of agents don't realize that to be the case. So we'll get into that and the details of how those buy downs work, how to utilize them when you're preparing an offer, how to actually get this information across to your buyers properly, so that way they feel comfortable moving forward with the process when they might have otherwise decided they were going to wait on the sidelines to buy. Because I've reached out to a lot of the agents over the last 2 weeks that we work with personally to ask, what is the biggest thing you're hearing from potential buyers that's preventing them from buying now? Because there are plenty of people that we've pre-approved over the last 12 months that have decided they're going to wait to buy. And the biggest thing that agents are hearing is rate, right? So we all know, it's all over the news, it's everywhere. We all know rates are high, right? Sure, they're much higher than they have been over the past 2 years. But with these buy down options, you can get someone an interest rate that's in line with where they were a couple of years ago, right before COVID, which was a more realistic rate, maybe something in the low 4s, possibly high 3s, depending on their credit profile and down payment. So I just want to talk about how those work, but first I'm going to start with a traditional buy down, because when someone hears rate buy down, they might be thinking that they have to pay discount points to get a lower interest rate, because that's how typical buy downs work. A rate buy down is not a new thing. What is more recent, or just has become more popular, are these temporary rate buy downs that are used to reduce your rate for a specific period of time, not for the entire length of the loan. So first, let's talk about a traditional rate buy down and how that works, and then we'll compare that to what these options are. So traditional rate buy down is when someone pays discount points. So a discount point is equal to 1% of their loan amount. They pay that as part of their closing costs to reduce their interest rate. And a typical discount point would reduce a rate by about 0.25%. So let's look at a scenario where a buyer is paying the maximum discount points. They say, hey, I want the lowest possible interest rate. I'm willing to pay the maximum number of points, which is 3 points. They can pay 3% of their loan amount in discount points. So let's just say they're buying a house for $500,000. And this buyer is going to put down 10%. So they're putting $50,000 down on this $500,000 property. That means they're borrowing $450,000, right? That's their loan amount. The points that they're going to pay are based on their loan amount, not their purchase price. So they're going to pay 3% in this example of a $450,000 loan amount in discount points. So that's $13,500 in discount points. And what this does, and this is based on today's rate, so I'm going to give you a real world example of this. A 30-year fixed rate for this particular borrower, assuming they have a 740 or above credit score, the current 30-year fixed rate, don't fall out of your chairs, is 7.125%. By paying 3 discount points, that rate drops to 6.125%. Right? So they're getting a lower than market interest rate, and this would be the rate for all 30 years of the mortgage. And it's actually going to result in a principal and interest payment of $2,735. Now, I want you to remember this number, or write that number down. It's very important, because when we compare how a traditional buy down works, when comparing it to an actual temporary rate buy down paid for by the seller, you're going to see the difference in monthly savings, which is the most important piece of being able to explain this to a buyer. So here we go, $2,735 at a cost of $13,500, which can be paid for by any interested party to the actual transaction. So a traditional rate buy down doesn't require the seller to pay for the buy down. It can be paid for by the seller, the buyer themselves. If you're an agent who contributes a portion of your commission toward your buyer's closing costs, you pay for by portion by the realtor, or a combination of all parties. We can even contribute by bumping the rate up slightly, right? So this is a traditional rate buy down. I'm sure you've seen that plenty of times, especially if you've been in the business for a while. You didn't really see them much over the last 2 years. So if you're a newer agent, it's unlikely that you saw too many people paying discount points because it wasn't really necessary. Rates were so low. However, it's become more common again. So you have a traditional rate buy down. Keep this number in mind: $27.35 principal and interest payment on a $450,000 loan for a $500,000 property. Now, what we want to compare this to are the seller paid temporary rate buy down options, right? Key seller paid. So, in my opinion, the best of these options is what's known as a 3-2-1 buy down. That's going to get the lowest possible interest rate because what it's doing is reducing the rate in the first year by 3%, be 2% less in the second year, 1% less in the third year, and then it eventually in year 4 goes to the actual interest rate where they would have started, right? Year 4 through 30. The plan is, and I'll get into more of that, they'll never make it to year 4 because they'll refinance prior to ever getting there, right? So 3-2-1 buy down. So as I said, let's say it's the same exact scenario: $500,000 purchase, $450 loan amount, right? Very important. Also on a 3-2-1 buy down, this is extremely important. In order to do a 3-2-1 buy down, the down payment needs to be a minimum of 10%. This is specifically for a 3-2-1 buy down, none of the others. So if they want to get the lowest possible rate, they're going to have to put a minimum of 10% down on the property. Now, let's just say the starting rate was 7.125. This is the rate they'd receive if they were not doing a buy down. The rate in year 1 is going to be 4.125%. Year 2, 5.125%. And year 3, 6.125%. Now, the rate will eventually go to 7.125%, but that's after year 3. And as I mentioned, the idea is they don't get to year 4 because the rates are going to end up going down, right? Market's going to improve. Fannie Mae expects rates to drop into the mid-4s by the end of next year. That means it's going to be an influx of refinances, right? So the idea is to refinance within the time period where they have the reduced rate. But I don't want to get away from this. I wanted to show you what these payments look like. So your payment at 4.125 on the same 450,000 principal and interest is $21.80. It's $24.51 at 5.125, and it's $27.35 at 6.125. Now, if you remember, if we did a if we did a traditional rate buy down, which was going to get them down to 6.125%, their payment was going to be $27.35 for principal and interest. Look how much lower their payment will be with a 3-2-1 buy down in years 1 and 2. That's substantial. You're talking about a difference in payment of $650 between year 1 and what it would have been if you did a traditional rate buy down to 6.125%. So if you have a buyer who's on the fence because interest rates are high, this is the option they need to see. You know, we have a couple of buyers, and I don't want to get off track here, but we've got a couple of buyers over the last 2 weeks alone that decided they weren't going to buy at all. And it was the 3-2-1 buy down that brought them back into the market. And now they're actually under contract as of this week. So this is very important. These things actually do work. And this is your 3-2-1. As I mentioned, 10% down is required to do a 3-2-1 buy down. This is going to get the lowest possible interest rate because you're getting that 3% reduction in year 1. However, the cost of a 3-2-1 buy down is also the most expensive. As I mentioned, this has to be paid for by the seller in the form of a seller contribution. And that contribution needs to at least cover the full cost of the buy down. The cost of these types of buy downs is equivalent to the savings over the period of time where they have a reduced rate. So on a 3-2-1 buy down, they have a reduced interest rate for the first 3 years, which is 36 months. So whatever the monthly savings is between these payments and what the payment at 7.125 would have been is the cost. So in this example, the cost of this buy down is $20,760. And you probably say, wow, that's a lot of money. Why would any seller agree to give a $20,760 credit, which is a great question. These often come into play when you have a seller who's about to do a price reduction on their home. All right. So rather than the seller reducing the price of their property by, let's call it $21,000 to $25,000, as they might have in this case, instead of doing that, the buyer agrees to pay the full list price for the property, and in turn gets a credit from the seller that will cover their buy down. And this does two things. It helps the buyer because a reduced interest rate is going to save them a lot more money than a reduced sales price. And it also helps the seller and their neighborhood keep their values level. Everyone's concerned about property prices going down. And that could happen and will happen if people keep reducing their pricing when they're on their listings. However, if they keep their pricing the same and agree to a seller credit to cover a buy down, that means they're selling their home at their list price, keeping the prices stable in their neighborhood. All right. So 3-2-1 buy down, like I said, is the most expensive of the buy downs, does have to be paid for by the seller, and needs a 10% down payment minimum from the buyer. Now, let's compare this to a 2-1 buy down. So same exact scenario, utilizing a 2-1 buy down. So a 2-1 buy down is a good option if you have a buyer who can't put 10% down. Maybe you have a buyer who is a first-time home buyer and they only have the ability to put 3% down. A 2-1 buy down is available to anyone who's putting at least 3% down on a primary residence, right? So a 2-1 buy down will come into play for a lot of your first-time home buyers. So a 2-1, if you did a $500,000 purchase, same thing. In this case, I'm going to show you with 10% down just for comparison's sake with the rate and cost, but they can do it with as little as 3% down. So they're doing 10% down. We're going to have the same starting rate of 7.125% that we had on the 3-2-1 buy down. However, in year one, they're going to be at 5.125%. In year two, they're going to be at 6.125% because you're only going down by 2% in year one, 1% in year two. And so the monthly payment is going to be the same as what we saw previously for year two and year three. However, I just want to show you here again, $24.51 is going to be your principal and interest on the first year. And you're going to look at principal and interest of $27.35 again, which is equal to what you saw on the traditional rate buy down for year two. And then it will go up, of course, if the rate adjusts in year three and they don't refinance prior to that. But the good thing with this, as I mentioned, is your buyer can put as little as 3% down if it's a primary residence. They don't have to put 10% down, knowing not everyone has 10% to put down. Same scenario, needs to be paid for by the seller. That's extremely important. You have to keep that in mind. The 2-1 buy down, though, is less expensive than a 3-2-1 buy down. This buy down would only cost $10,550. So your seller credit, right, on this 2-1 buy down is less than 3% of the sale price. So seller still has to pay for it, but if you're not able to negotiate a $20,000 buy down, or if your buyer doesn't have the 10% to put down to go with a 3-2-1 buy down, this is an alternative that will still reduce their interest rate, make it a little bit more palatable for them, and save them money on a monthly basis. Now, there's also a 1-0 buy down available. It's far less popular. It's the rates reduced by 1% in year one, so maybe it's 6.125. The cost is a fraction of what you see here, is around $3,000, but it's rarely used for anyone, right? The most popular are your 3-2-1 buy down for anyone who's able to put a large enough down payment, 10% or more, or a 2-1 buy down if they're going with a lower down payment option. Now, you might say to yourself, well, what if I can't negotiate a credit from the seller? How am I going to do any sort of buy down for my buyers? And that's a very good question. If you go to just about any other lender but us, you're stuck. You wouldn't be able to do anything for them when it comes to these programs. But like Adam mentioned earlier on in the Zoom, we actually just released a proprietary buy down product that can be covered by any interested party to the transaction. So we're offering a 2-1 and a 1-0 buy down for that product. The 2-1 is going to be more popular. Like I said, a 1-0 is far less popular. But the way it works is exactly the same as what you see here. The difference with doing this type of buy down versus doing a buy down that's paid for by the seller is the starting rate's going to be a little bit higher. So real world example today, you're at 7.625% is your actual rate. You'd be at 5.625% for year one, 6.625% for year two. Now, the cost of this, like I said, can be covered by us as a lender, can be covered by the buyer themselves, can be covered by the seller, can be covered by you as the agent, can be covered by the title company, or any combination of those individuals. And the cost for this buy down is only $67.50. So it's roughly 30% cheaper than a 2-1 buy down that has to be paid for by the seller. So you can still have the seller pay for this in full. And you can say, hey, seller, we need a $6,750 credit instead of telling them that you need over a $10,000 credit, right? Or if you're trying for a 3-2-1, over a $20,000 credit. The problem is with those seller paid buy downs is if the seller won't give the full credit, then you can't do it. If it costs 20 grand for the buy down when you're using a seller paid option, which is what just about every lender offers, and the seller won't give the 20,000, they'll give 10. Well, that doesn't matter. You couldn't do the 3-2-1 buy down. You'd have to do the 2-1. Or if they're only willing to give 6,000, well, that doesn't cover the full cost of that buy down, and therefore you can't do it. This gives you the ability to still get your buyer a rate buy down without having to worry about the seller being willing or able to contribute. And this probably comes into play more in situations where you have an appraisal done on the property and you agreed to the seller buy down, but maybe the appraisal came in low. And now there's not enough room in that purchase price where the seller is able to contribute the full amount. We can transition from a seller paid buy down to a lender paid buy down like this, where without this option, you'd be stuck. The buy down would fall to the wayside, and your buyer might decide, you know what, if I'm not getting that buy down, I'm not getting a house. Because if this is what got them into the market or maybe back in the market, knowing they can get a more attractive interest rate, and that goes away, they might not want to buy any longer. So it's extremely important to keep in mind. This is going to be a huge product over the next few months. I would say probably the next 9 to 12 months while rates are still up before we see that drop that's expected. And it's something that you're going to want to take advantage and utilize. You want to have as many tools as possible in your arsenal to use for your buyers in this market. The more you can offer them, whether it comes to the products that your lender is able to offer and just good information that you might have from your experience, makes you stand out from everyone else. Right? Utilize these tools. They truly work. We've been using them at 3, like I said, from last week to now, 3 people that were not in the market that decided to get into the market specifically because of the buy downs. In their cases, they were putting enough money down to do 3-2-1 buy downs. And on 2 of them, we actually got appraisal waivers. So we don't even have to worry about running into issues with the property under appraising. But it's a great, great product because when someone tells you they're out of the market because of rate, and you can tell them, hey, I have buyers that are still getting rates in the 3s. Well, what are they going to say to that? You know what? I'm willing to speak to your lender, hear what they have to say, and then let your lender, whether it be us or whomever you use, hopefully it's us, let them handle the conversation and explain how this works. You need to know the basics, of course, because you want to sound knowledgeable, but you don't need to know everything. Rely on us or your lender to know all about these products and how to actually convey the information to your buyers, right? As listing agents, this is a great tool to market a property where I said you're about to reduce the price. Rather than doing that, you can market that any buyer for this property has the ability to get a lower than market interest rate, right? Because like we said, rates are what are keeping people out of the market. What's going to actually appeal to someone? Oh, I can get a lower than market interest rate. I'd like to see what I could do on this. So keep these things in mind. Someone might tell you, I'm waiting for the market to improve before I go ahead, or I'm waiting for prices to drop before I go ahead and buy. Well, what's that person going to do when rates drop in 12 months and everyone else who has their same mentality is back in the market? See, supply and demand. When demand is low and there's supply, sure, prices are going to stay stagnant or they might drop slightly. But when rates drop and demand goes back up, you're going to have more people flood the market. And guess what? The prices are going to go up. So waiting doesn't necessarily make sense for everyone. You have some people that just don't qualify, and I get that because rates are high and they still have to qualify off what the actual interest rate is. But for those that do qualify, waiting typically doesn't make sense right now, especially if they can use one of these programs. And here's something that's really, really cool about these temporary buy down programs versus a traditional buy down that I showed you at the beginning. If someone refinances anytime within the lower rate period, so let's say on a 3-2-1 buy down, they have 36 months where they have a lower interest rate. And let's say that Fannie Mae is accurate and rates do drop at the end of next year. So let's say they're 12 months into their 36 months of their loan. The portion of the credit they received from the seller to buy that rate down is still available to them. And what that's going to be used for is to pay the closing costs on their refinance. So they're going to close on this home, get a lower than market interest rate, refinance, and it's not going to cost them anything. So that means the balance on their mortgage will not change from the time that they buy the property through when they refinance. When typically on a refinance, you have to roll closing costs in or come to closing with that money. So it's a huge, huge benefit. On top of the fact that they have a lower than market rate, they get a no cost refinance on the way out. So make sure you're able to convey this information to your clients. It's extremely important. I'm sure they might be hearing about it already. So the more you know about it, the better it is for you, because you want to be separated from everyone else in this market as far as agents are concerned. And having that knowledge is key. Right. So I want to open this up for questions. I want to get too carried away. Does anyone, let me see. So someone had a question, are there property and or loan type limitations to these buy downs? Great question. So as far as property, we can use this on single family condos, townhomes. As far as occupancy is a big thing. It has to be either a primary residence or a secondary residence. You cannot use these on investment properties, at least not right now. I think that was the primary question.
I've got one in the chat. I can read it to you, Brandon.
Yeah, please go ahead.
Yeah. Can the seller still contribute 3% if conventional, since the amount of buy down is over 3%?
So that's a great question. So what's being referenced in the 3%, the 3% contribution on a conventional loan is going to apply when the down payment is going to be less than 10%. If the down payment is 10% or more, they can actually contribute up to 6%. And that's the reason why you can only use a 3-2-1 buy down when someone's putting 10% or more down, because the contribution, as that person said, the contribution needed from the seller exceeds the 3%. So that's why the 10% rule applies. However, on the 3% to 5% or less than 10% down, if you do a 2-1 buy down, it comes out to 3% or less of the loan amount of the purchase price, as far as the credit's concerned, and you're fine with that.
Thanks, Brandon. So Brandon, if you don't mind, just will you write your cell phone number on the whiteboard? So what we're doing, as we mentioned, the seller buy down is a proprietary product. So what we're doing is we're registering agents that we work with or that want to have access to this program. Brandon's going to go ahead and write his cell phone down. Just send him your contact information. We'll make sure we put you on the lender buy down list. And I'm also going to go ahead and send out just kind of a cheat sheet. Brandon rattles this stuff off. He lives in this world. Again, it doesn't come as natural to most folks that aren't originating loans all day. So what we want to do is just kind of take that burden off of you, and just kind of come up with a strategy to bring this up to your buyers. If you need help with that, we're always available. That's what we do. We're talking to buyers. and potential buyers all day. We're always here to help. I think we've got a couple more questions coming in. Just give me a minute, Brandon.
No problem.
Yeah, so if the buyer's pre-approved through us, basically it's a long question. I'm not going to read the entire thing, but you do have to have a strategy around this. I'm really glad you brought that up. So we're always in touch with our agents during the pre-approval process, throughout the home shopping process. So it's very, very important for everybody to be on the same page, right? So we want to be on the same page with our buyer, with the agent that we're working with. And we also have to communicate this to the listing agent. So yes, we want to be in touch and very, very involved when you're making an offer on a property. Brandon, do you have anything else? Did you think of anything else that you'd like to share?
No, I think it's a big thing, as you mentioned, just the way we operate when it comes to this. As I mentioned, I don't want you to feel like you need to know everything as the agent. Please lean on us to help handle this. We can explain it in detail to the buyers or / borrowers. We call the listing agent on any offer that's made. And so when an offer is made that has a buy down built into the additional terms, I always call, or our team always calls, depending on who on the team is working on it, to be able to explain exactly what it is. Because a lot of the agents, especially those that haven't been in the market up until 2 years ago, aren't familiar with what this is. And so we always call behind our offers, especially in these cases, so we can explain exactly how it works. And an important thing is we have you put verbiage that specifically states the credit that's being requested is to be used for the buyer's interest rate buy down. And the reason we do that, rather than, hey, seller to contribute $20,000 towards buyer's settlement costs, or things that you might have used in the past, is you want to make it very clear this is a qualified buyer. They have funds for their closing costs. They have funds for their down payment. This is strictly to get them a lower interest rate to help them with the purchase of the home and help your seller get that property off the market when they might have otherwise had to reduce the price significantly to make that happen. So we convey that information. We work hand in hand with any agent that's part of our team, we'll call it, in order to help these offers get accepted, how to actually present them properly, which is extremely, extremely important. It's all about the presentation, because if delivered incorrectly, it's not going to give you the result you're looking for. I don't know if there's anyone on here that I happen to be working on a transaction with me right now involving a 3-2-1, but I'm sure they would attest to the fact that us working together as a team is what allowed for those offers to get accepted, by being able to convey the information properly to all parties, meaning to the buyer, to the seller, to the listing agent. It's extremely, extremely important. That's why I said you having knowledge is important, but still lean on us or your lender to help convey the information properly to anyone in the transaction that needs to know about it.
Got one more comment slash question about agents having to be careful about talking rates in the MLS. Is there verbiage that we can use in an MLS listing? I know there's a legal hotline for real estate agents. I think it'd be a good idea for, I'm glad you brought that up. I think it'd be a good idea for us to kind of come up with, something that we can run by the legal hotline to see, you can't start quoting rates, because you have to make sure that everything's disclosed and your listing is going to end up looking like a mortgage commercial. So that's not necessarily something you want to do. But I think we can come up with something creative that will entice more buyers to your listings.
Yeah, I think that something that I have already seen someone do is they put wording along the lines of seller willing to contribute toward buyer's interest rate buy down. Just something simple where it's not referencing rate or percentage. That's the important thing. You want to stay away from quoting actual rates or percentages, because then you have to involve an APR, and it gets a little bit finicky, because you also need to know how was that rate determined, credit score, occupancy type, right? There's a multitude of things. So by keeping it more vague, a seller willing to contribute toward buyer's interest rate buy down to obtain lower than market interest rate. Very simple. It's not referencing anything specific regarding the interest rates, but it's giving the idea of what can happen. That's for listing agents, by the way. Obviously, that wouldn't help on buyers, but that goes with your question.
Gotcha. All right, I think we're going to wrap things up. As I mentioned, we'll send a follow-up email with a cheat sheet so you guys can kind of have an overview of everything that we went over today. As always, you can give us a buzz. Brandon's numbers on the board behind him, so feel free to call us anytime. We're awake, we respond, and have a good rest of the day. Thanks, guys.
Thank you.